Now, Peter, a lot of people are saying that the great 30-year bull market in bonds is over. What's Pimco's view of that?
Pimco's view is that we have seen, yes, a significant reduction in bond yields in developed markets. I think it's very important to make that distinction between developed and developing markets.
Well, we're talking principally about the US, really.
Yep, okay.
15% bond yield in 1982, 2% now. So 30-year, significant 30-year bull market.
Yep, which has been accompanied by significant reductions in inflation around the world. So I think it's eminently sensible that bond yields should be where they are in the US. I guess the question that follows from that, Alan, is are they going up anytime soon? And our very strong view on that is no.
Well, you have to say that because you're selling a bond fund.
Well, just because yields go up in one country, in one particular part of the market, doesn't necessarily mean that it's going to hurt portfolios, because there's a wide range, as an active manager, there's a wide range of tools we have to use that we can protect clients in those sort of events.
But can you point to a period in history when bond yields actually went sideways for a long time? I mean, before 1982, there was a 30-year bear market in bonds that started in 1946.
Well, no, I can't. But our view is that the immediate future, as best as we can forecast, and anyone who says they can forecast more than 5 years out, I think is just having a go. But the immediate future suggests to us that because growth around the world is going to be lower, interest rates will be kept lower for longer as a result of that.
That in fact is the sort of the new normal paradigm that Pimco refers to, a decade of very low growth.
Yep.
It's not a very pleasant picture, is it? Unless you're a bond fund manager.
Well, it's not a very pleasant picture for anyone, really, because it implies continuing high levels of unemployment. You look at the US unemployment rate, which has come down a little off the highs, from 10 down to the early 8s. That's good news, but part of what has been driving that is two things: drop in the workforce participation rate, and a large number of people, somewhere around 40 to 45% of people now, who have been unemployed for a very long period of time, who are losing their workforce skills and whose ability to re-enter the workforce in the future is going to be quite limited.
But what we've seen in America, leaving aside that total growth picture, is that American companies have led the world in becoming more efficient and more productive. The indexes are up 25-30%. And last night we had Goldman saying, hey, this is a magnificent time to buy shares, stocks, because they're going to outperform bonds. And it's on the back of what's happened to American companies, as distinct from what might happen to the American economy.
Well, American companies, yes, you're right, they've become a lot more efficient. They're sitting a lot of cash, but do you see any great rising demand for their services or goods?
Yes, but they're doing it much more efficiently, and they're learning to use the technologies. And so their profits are doing reasonably well. And if you're talking about from an investment point of view, it's stocks versus bonds. And here's Goldman saying stocks are what you should go for. You're saying bonds. You'd have to say that given the amazing the management performances of American companies are just outstripping Australian companies by light years. You'd have to say it's a good thing for the stock market in America, as distinct from the bond market.
Well, on the Goldman thing overnight, I mean, I think everyone knows that equity trading volumes in the US have been very subdued. Therefore, brokerage has been very subdued. For anyone who needs that as a large part of their business is going to be trying to talk that up. I think it's an interesting report, but somewhat predictable in terms of its.
You're saying that that Goldman are treating the share community like Muppets, is that right?
Your words, Rob.
But even if you're right, and that bond yields probably aren't going to fall, aren't going to start rising rapidly, that we're not into a big bear market in bonds, the capital gains are probably over. I mean, with bond yields where they are, they're not going to fall any further, and the yields are so low, why would anyone buy bonds?
As an Australian investor, which is I think what we're talking to here, you've got to remember that most Australian managers will run global bond portfolios on a fully hedged basis. So that, yes, you're investing in a treasury, 10-year treasury at the moment might give you 2.25%. But you've got to remember that if it's run fully hedged, you pick up that yield differential between the cash rates in the two countries. So if we own a US treasury and a global bond portfolio for an Australian investor, the yield we're actually delivering to that investor from that security is in the early sixes. So yes, they seem low on a nominal sense, but you've got to remember from the Australian investor's perspective, it's quite a different
Explain that. How do you get 6%? more than 6%? How do you get more than 6%?
That's
How do I get, as an investor in Australia, how do I get more than 6% investing in US Treasuries?
because you're running the portfolio on a fully hedged basis,
Right.
right? So
do I need the currencies to change?
no, as long as it's nothing to do with the currency. It's to do with the differential cash rates between the two countries. So the US cash rate is in the 0 to 0.25 range. Australia's at 4.25. So long as that differential is maintained, you pick up the yield difference between those two cash rates from investing offshore and managing it fully hedged.
So effectively you get paid to hedge.
Correct.
In relation to that bond market, Peter, public sector debt to GDP ratios around the world are at astronomical levels and closer to 100% than anything sustainable. How do you factor that into the outlook for the market, given we're going to see huge amounts of refinancing? Despite all the austerity measures and the attempts to get down deficits and debt, we're going to see huge amounts of refinancing over the next decade from the public sector. Well, but we've also seen a huge amount of the volume of issuance in the corporate sector in the last year or two has been quite phenomenal, yet it seems to have got away at very, very reasonable rates. So I think what we're seeing around the world is an interesting phenomenon where investors in most parts of the world have accepted the fact that maybe this new normal thesis that we've been promoting is what the world's going to look like for a period of time, and they want to have a larger component of bonds in their portfolios relative to what they used to pre this GFC environment. So I think the demand is still there for, now Europe's a bit of a different case because they're buying each other's debt, but in the US the demand does not seem to be weakening at all, whether it be corporate debt or sovereign debt. Does that play into this discussion about the sort of structural reweighting of investors' exposures away from the traditional overexposure to equities towards more defensive asset classes?
Very much so, and great example in the last week or so with the Ford pension scheme in the US. Now Ford, as you know, was one of the few of the US car companies that didn't seek a bailout from the government. It's got through it pretty well. Ford, unfortunately though, the pension fund, as a result of the asset allocation it had, has got a $3.8 billion hole in it, which has only occurred over the last 3 years. So they've now decided to considerably up the level of contribution to that fund, which is obviously going to have an impact on corporate profitability. But they've also made a massive allocation shift in that fund from a 45% bond weighting to an 80% bond weighting, just in the last couple of weeks. And the rationale for that, as described by the Treasurer of Ford, was to try and just take the volatility out of that pension plan, provide a bit more security for the members of the plan, and get a lot of the volatility off the balance sheet in terms of the impact of having to make contributions depending on volatility of equity markets.
Is that a defined benefit? Or
that's a defined benefit plan, yeah.
Right, so obviously they're getting enough in yield to pay the defined benefits.
Would you say that, let's switch to Australia now,
Yep.
where your bank deposit, 5-year bank deposit yield is getting close to 6%. And it's government guaranteed, basically, as long as you don't go above $50,000.
Yes.
So we're talking about that market. Would you say that would warrant self-managed funds, for example, to switch and downgrade their equity portfolios and get themselves 6%?
Well, I think it's going to take a little while for investors, particularly in that self-managed super space, to accept the lower yield environment. A lot of people move out of industry or corporate super funds and go into self-managed super funds because they think they can either do it by themselves, they can get a better return than the fairly lacklustre returns produced by some of the big funds over the last few years. So they're still in that 8, 10, 12 target range in terms of returns, which we don't think we're going to see for quite some time. 6%, yes, a term deposit, I think, is a good component of investors' portfolios, particularly self-managed super funds. All we're saying is that it shouldn't be the only exposure you have to debt markets, because the big thing with a term deposit is that you've got no control, over liquidity. If you need that money back for some reason, banks have become very, very punitive in terms of the level of if you want that money earlier than the 5 years.
Yes, I understand.
They've become very, very difficult in terms of the penalties they'll apply for early redemption. And also you've got quite significant reinvestment risk, because who knows what the environment's going to be like in 5 years' time. You might be getting a good yield now, but we could be in a very different economic environment, very different interest rate environment. You've got no control over if that's your only exposure to fixed income markets. So when we talk about portfolio construction with advisors and talk about the defensive component of a portfolio, it's all about have some cash, have some term deposits, but also have some exposure to actively managed bond funds. So you're getting all of the components of the bond market in that defensive area of the portfolio.
Apart from the fixed interest funds, we've seen the sort of nascent development of a listed corporate bond market in Australia. Are you supportive of that?
Yeah, very much so. And there's a few different components of that that are starting to emerge. You've got the ETFs, which have been launched, albeit only passive, in the last couple of weeks. You've got these new AQUA regulations, which the stock market is going to introduce the listing of existing fixed income funds, and we're very keen to get some of our funds into that space when that becomes available later in the year. And then, listing corporate bonds, I think, will also be quite advantageous to investors, because whilst you've got some concentration risk if you're just in that one single corporate name, and some obvious credit risk as a result of that, anything that can increase the level of exposure and understanding of the bond market in Australia, we think would be a good thing for investors.
Peter, the foreign ownership of Australian government bonds is up to 76%
Yes.
or so from about 25% not that long ago.
Yep.
How much of that is Pimco?
Well, I mean, all of our money in Australia is managed on behalf of Australian investors, so there's a look through to that Australian investor.
No,
Offshore?
I mean the offshore Pimco
Yes.
funds, are they investing in Australian
Well,
bonds?
there's two things that we do offshore, three things we do offshore. One is any global fund run out of any country in which we operate will have an Australian component, because we're favouring Australia as a market at the moment. Two, we've just launched an ETF in the US market, which is purely Australian bonds. And three, we have a fund managed for Japanese investors out of our Japan office, which exclusively invests in Australian bonds, which has been the most successful bond fund in Japan for the last 5 years. It's raised about $3.5 billion. So
Right.
there's a lot of interest in Australian bonds, given the yields.
So you'd like the Australian government to keep running deficits, wouldn't you?
Well, I've got a bit of a
there is
split answer on that.
Well, there is a bit of a problem, because the Australian government is going to stop running deficits. They're not going to borrow anymore. There's not going to be much stock for you to buy.
Well, the supply at the federal level may or may not diminish. We'll see how that comes out in the next, in May. But remember, you've got stock at the state level as well. Which is many of the state governments have decided that debt, isn't such a bad thing after all, and New South Wales and others are starting to look at different parts of the bond market to try and help them fund their infrastructure.
So do your ETFs invest in state government bonds as well as federal?
Well, we don't have ETFs at the moment. Oh, sorry, our offshore ETFs. Yeah, absolutely, yeah.
Peter, our biggest borrowing offshore in Australia comes from our banks, and they're getting squeezed in terms of their offshore borrowing. Have you thought of overseas funds to invest in our bank loans?
Well, we, about 3.5 years ago, wasn't so much a fund, but talked to investors about a strategy where we would be exclusively owning bank debt, and we had quite a number of clients who were quite interested in doing that. I guess that sort of waxes and wanes with offshore investors' view of our banks. And one thing you'd have to say at the moment is that there's quite a wide difference of opinion between Australian investors' view of our banks and offshore investors' views, and it's largely got to do with what you think is going to happen with the Australian property market. Even my colleagues in the US, and I've got one out here with me at the moment, looks at the Australian property market and says it's the most overvalued property market in the world. It's a serious bubble. Now, that's not necessarily the view of us here in Australia, not just because we own Australian property. They're looking at all sorts of different metrics that they use to standardise property markets around the world, and say that they think Australia is is seriously overvalued in the residential space.
So, in terms of Australian banks trying to borrow to fund their wholesale portfolios, they're caught in this crossfire where the overseas people just don't like the look of the Australian bank balance sheets and are very reluctant to invest in Australian bank debt unless there's a very high rate.
Well, yeah, but also there's a lot of competition for bank funding around the world at the moment as well. So it's not just Australian. Australian banks are competing with all sorts of other banks in all parts of the world. But you're right. There is an emerging view that because Australian banks, the big four Australian banks, are so tightly levered into the domestic property market that if there was to be some more severe correction in the property market, that may have an impact on bank balance sheets.
But the problem is that the global investors are worried about the Australian property market, which means they're worried about Australian banks.
Correct. Now, it's interesting that you say that, because most Australian banks, the average LVR across their RMBS portfolios is still in the 50s. So, there could be quite a significant fall in Australian property prices before we'd really see any severe impact there. But it's the perception that counts at the moment, and there's certainly that perception.
So our banks are basically being ranked with banks, say where? Some of the European banks, or our banks, in terms of borrowing, where would they be classified? What's a similar overseas bank to the view of the overseas investors?
That's a bit tricky, because
It'd be better than European banks, surely.
well, there are some European. I mean, not all European banks have been, have the difficulties that the general perception of the European banking system is. Not all US banks have the same troubles. I think it's got a lot more to do with the underlying asset, the dominant asset base of the Australian banks, and the views about that, the prospects for that.
Mm-hmm. It's interesting because it's to some extent self-fulfilling, or at least potentially self-fulfilling, that if the interest rate that the banks have to pay in the wholesale market keeps going up, that will have a damaging effect on the property market in Australia.
Well, ultimately that's true, yeah.
Of course, if the government was to guarantee the banks, that would make a huge difference, wouldn't it?
Yes.
Because then,
yes, but then
your funds would invest in it, wouldn't they? Because it'd be a government guaranteed security.
Well, I don't know. We're not saying we don't invest in Australian banks. We hold quite a lot of Australian bank paper in our portfolios. But simply transferring the risk from the banks to the government, then people start looking at the government, just as they are in Europe, just as they are in other parts of the world. Now, I'm not sure that.
Get this taxpayer out, Bob.
Okay. That's okay.
The Pimco view of Europe and where it is at the moment, all this liquidity that's being poured through the Eurozone, is that a solution, or is that the crisis dormant in a sense?
The crisis is there and will be there until there is some concrete and widely accepted plan to reduce the overall level of debt. Just moving around, as has been done for the last 2 or 3 years, is clearly not the answer. So it's the crisis just keeps on being put off. Our CIO Mohammed Al-Arian keeps on saying it's just kicking the can down the road further and further and further, and that's all that's happening. It's interesting to look at the UK, which is probably the first country to put in place quite significant austerity measures to try and pull the fiscal position back into place, and then ultimately try and get the debt down. It's been the markets have reacted well to all of those plans and proposals in terms of how they've treated UK interest rates. So for us, there's a bit of a template there that the rest of Europe could look to actually get serious about this, as opposed to just move it around.
So do you think the crisis is still ahead of us?
We have a view at the moment that there is the prospect of what we call this bimodal situation, where everything looks a little bit calm at the moment, but there needs to be further resolution. And it may well be that if you think about if you think about a normal distribution of returns over time, you've got these right tail events and the left tail events. The left tail events being the downward spiral. We think there's probably more significant chance of something on this side than there is on this side.
And how will that play out? Where does it start? The next wave.
Well, it starts with a real default, an acknowledged default in Greece, and the need then for Greece to think about how it exits the EU. That I think would prove very unsettling to markets around the world.
And that would then spill into Spain, Portugal, Italy, Ireland.
Well, it starts to then. One of the interesting things about the EU when it was formed is there wasn't really any breakup mechanism enshrined in terms of, okay, if a country's going, how do we get it out? What do we do with the currency? We've been thinking a lot about if Greece was to need to leave the EU. You're going back to things we haven't seen for a very long time. Ring-fencing the currency, capital controls, no movement of people, because they're all still holding euro, and obviously they can't continue to do that. They need to move to a different currency. So there's a lot of things to think about were that to occur. Now, the ECB has been very successful at
putting that off. However, there's a few, tricky clouds on the horizon. Greece has got elections coming up. There's no guarantee that the party or people that are elected there are going to be sympathetic to further austerity for Greeks. And the other thing is, of course, the Greeks are now starting to leave the country. In 2010, there were 50 applications from Greeks to migrate to Australia. In 2011, there were 12,000. That's just Australia. I think we're starting to see...
I didn't know that, 12,000.
Mm-hmm.
Wow.
Mm.
Disconcerting for the Greeks.
They're coming to Melbourne to drive taxis. Tell me, to what extent did it set back your group when you miscalled the US Treasuries back some months ago, and you thought that the Treasury market would, interest rates would fall, or rise, and you moved out of those areas, and it was a wrong call. How has that affected your group?
That decision was really confined to one fund, which was a mutual fund that we market in the US called the Total Return Fund. It really hasn't had a very significant impact for two reasons. One, because we were very public about admitting that we got that wrong, and two, we were very public about explaining the reasons why we got that wrong. Because in this sort of environment, our primary responsibility as a manager of defensive assets is to ensure that we have the ability to return our clients' capital, to protect that capital. Secondary is an obligation to get a good return on that capital. And that's just because of the sort of markets we find ourselves in at the moment. And I think people understood that the rationale for us doing that was because we were trying to protect from what we thought was a serious risk in that market. Now, it had a bit of a blip in terms of impact on fund flows into that fund in the US in the last 2 quarters of last year. Performance has come back quite strongly in the first part of this year for that fund, and flows seem to return to more normal patterns.
We'll have to leave it there. Thanks very much, Peter.
Okay, thank you.